Hi, welcome back. In my last video, I explained how to estimate Lululemon future revenue profit, and I tentatively reached the estimated value per share. But there are still several other activities that the company's management can do or did that will affect the company's value. One of major activities many businesses did are acquisitions. Acquisitions means when one company buy another company usually with a higher than the market price. So usually what they will do is say if one company they make extra money during a fiscal year, and they will go to the investment banks such as JP Morgan, Wells Fargo, Morgan Stanley, Citibank. They will tell them, "Oh, we made extra $1 billion last year, and we want to acquire a company. Do you think you have a good target?" So if you are the investment bankers, what do you think they will say? They will always say they have a target, right? And not only that, so when the company wants to spend $1 billion, they will say, "Oh, we have a good target," and that they will seemingly estimate the value of the company and reach a price. And they said, "We found a good target. You want to spend 1 billion, and this company worth 985.65. It's always a little bit lower than your target, but the difference is very small. Why is that? Because the so-called advising fees those investment banks will get depends on the size of the acquisition. So the more the company spend to acquire another company, the more those investment banks can earn. So when they do those targets, they will made up several different terminology. One of the most already used terminology is synergy. So when investment banks say synergy, that means that 1 plus 1 is bigger to 2. They will say that if you acquire this company, you can either reduce the cost or you can boost both of your profit margin or growth or revenue in the future. And sometimes they will say you can grab more market share, which can be true, but more market share does not necessarily translate to higher value. We know that these investment banks, they have so many analysts. They are from Wall Street. They have best graduate from Harvard, Stanford. They have smartest people in the world. We should expect that this investment bank averagely can generate a positive return for the company who acquire other companies, right? But if you check the data, this data is from Fortune magazine. You can also check other data sources like McKinsey, Harvard Business School. I can guarantee that you can find that at least 70 to 80% or even higher, 90% of merge and acquisition end up losing the company's money, which means that it end up losing stockholders' money. So why is that? First, like we said, how much advising fees investment banks, for example, JP Morgan will earn, depends on how large the size of the acquisition. So they have a nature conflict of self-interest. They have an incentive to exaggerate the value of the target. Second, if you are the CEO of the company and you have, say, 5 years left in the company, but the target company you acquire, its problem will not pop up until 10 years after. Then you will have the incentive to finish the deal, take the money, take the bonus, and just don't care about what happened after you leave the company. That's why most of the merchant acquisition failed. And it's also because of that, it is very important to estimate the value of the merchant acquisition when the company you are valuing announced to acquire another company, because the effects can be huge. During the COVID, Lululemon advised by Bank of America to acquire another company called Mirro for $500 million. The company Mirro is mainly selling one product, is what you are seeing on the slide. How the product works is you can put the Mirro, the devices in your home, and you can connect it to the internet to do the workout with videos on the Mirro. And when I saw the deal, that just reminds me of some English words that I learned from my friends. When I was in US, the delivery guy had a hard time to find my house. So I bought something from Amazon, which is called
Solar energy powered roof fan.
I know it sounds, but how it works is like during the day they can collect the sun for energy. You can choose the numbers, and in the night, those numbers can become bright sun. So I just buy that so that the delivery guy can find it in my place easier. But my American friend saw that. They said, "Oh, you just bought a piece of garbage." That usually means you are buying something that is not useful. You are wasting money. So when I saw that Lululemon bought Mirror, my reaction is, "Oh, you just bought a piece of garbage." Why? Because they spent 500 million, and these devices cost $1,500 each to buy, and you also need to pay $39 monthly subscription. Just think about how many people will buy such devices at home. During that time, I in fact have some back pain, so I also did yoga daily to just release my pain. And you know what I do yoga? I just open my laptop, go to YouTube, search yoga with Adrian, and I just did that. You can even do that with phone. How in the world that people will buy such trash just for working out? So when I saw that news, my plan is to estimate how many revenues Lululemon can make because there are always some people will buy that, although not many. How many revenues they can make in the future and how much money they can lose in the future. After how many years the company will decide to stop losing money by stop selling these devices. I was doing the calculation. I do find numbers on the balance sheet, and they also expect to lose about $60 million in 2022 and another $20 million in 2023. I also did some further calculation. So I expect during that time, when I buy the company in 2024, I expect it still lose another 2 year, $40 million. So that's why in my cash flow valuation, after the operating income, after the paid tax, I subtract the reinvestment and I also subtract the. I know it looks like a small number, but it's just because this specific example. You cannot guarantee that other company you are valuing cannot lose more. Many years ago, JP Morgan advised the famous Germany pharmaceutical company Bayer AG to acquire another agriculture company called Monsanto. That is a company producing fertilizer. However, it was found later that Monsanto's fertilizer can cause cancer, and the legal cost has already incurred $10 billion. So if you are a valuable company like Bayer AG, you probably think that you are doomed. This company is done. That's already right. You can try to check information about law and do your best estimate how much legal fees penalties the company can pay in the future, and you subtract those fees from the cash. If after that the stock price is still lower than estimate, you still can buy the stocks, but it's important to check those details. Another thing that is very important about Lululemon is the marketing expenditure. Before talking about that, I would like to explain to you a little bit terminology. In finance, we have expense and expenditure. Usually, expense means the company spent in current year or current quarter, so it's short term. While expenditure means the money spent today, but its effect probably will happen many years later. For example, if you are Apple or Nvidia, you design some product, you design chips or phone today, you do not expect to collect all the benefit for current year. They probably at least make money in the next 3 to 5 years. So if you record all of those research and development investment for the current year, like accountants do, you will overestimate the expense, underestimate earning, and underestimate the stock price. But to decide whether spend is expense or expenditure, you need to use your own judgment. You need to think about the company's nature. For example, for most of company, accountant will regard marketing expense as the operating expense. They are expense only for the current year, current quarter, will have few effects for the future. However, for the apparel company or fashion company or cosmetic company, I believe marketing expenditure is one of the most important investments. When I was a child, I always think why we always saw Nike, Adidas commercial or advertisement. I watch like soccer game, NBA game. Why they still put advertisement on those places when everyone seems to have already know Nike and Adidas. Later, I realized is that what they want to do is every time you want to buy shoes, every time you want to buy sportswear, Nike and Adidas come to your mind. And for those companies, they have few way to market except those advertisement. For cosmetic product, I believe that it is always important to make the people believe that your product can make them prettier, rather than literally make them prettier. That's why they pay a tons of money to many Hollywood star commercialize their product Because when people watch those commercials, they have a hallucination that they can become as pretty as them by using their product. So that is why marketing expenditure is important in this business. But if you're talking about things like Costco or things like Caterpillar, probably the marketing expense is not a big deal. So it's very important to decide whether a money spent is expense or expenditure based on business nature, rather than categorize them like accountants do. So in this graph, I also collected those most successful sportswear company, and I calculate one thing called marketing expenditure to sale ratio. So what I do is I use their marketing expense. Usually you can find on the company's income statement. You can also check my previous video about three financial statement. You found their marketing expense on their income statement and you divided that by sale revenue on that year. So by doing so, I get a ratio called marketing expense to sale ratio. And when I estimate future revenue, I multiply with this ratio so that I can estimate the future marketing expenditure. And I believe that such calculation makes sense because if the company have higher growth, they usually require higher marketing expenditure. So as you can see that the marketing expenditure for this company range from about 4.5% to 20%, and most of them are stay around 15%. If you think about, in fact, it's comparatively high ratio. So if you sell $100, you need to spend $15 on the marketing. So you can tell that how important marketing is for sportswear company. So here, if you don't know how to do the valuation, I already show you with Excel. So first we have the after-tax operating income, and we subtract the normal reinvestment, and I subtract the special expense from the Mirro from this acquisition loss. And after that, I multiply the marketing expenditure ratio to revenue with the revenue. So I get a marketing expenditure. You spend this year, but the effects will not realize until 2 or 3 years. I divided the market expenditures by two, and that's what called market expenditure amortization. So I subtract the half of the marketing expenditure for current year rather than all of them. But also, when the company spends them at marketing expense, accountant will record them as expense for the current year. So when they do that, they decrease the operating income, but that also will decrease the tax, right? Because, like for example, if you report a 1 million loss this year upon other earnings you have loss, you can save tax by 1 million multiply your tax rate, right? So here, I just multiply the marketing expenditure amortization with the tax rate. I can know that how much tax benefit the companies save by doing that. After all those adjustments, I can get the free cash flow for the company. After I run distribution for the different marketing expenditure to sale ratio, I have the new stock price valuation distribution. This is what I got in my last valuation in April 2024. As you can see, this is the average median. This is the median of all data. It's about 256. And if I consider the median with low or no debt is 289, and the median with no debt is 298. I did buy half of total shares I want to buy at 298. I bought another half share at 253 and 235. Right now, I want to see that why the stocks keep declining. If you see here, the stock originally decreased from 350 to the 250, and they jump up to the 400, but decline even further to 220. About 2 months ago, Lululemon just held their another quarterly report. Their earnings beat the analyst estimate, which means how much they earned per share is higher than how analysts expected. However, in the earnings, they give some guidance. They expect the revenue growth for the current year at about 7 to 8%. So remember that investment bankers, they are using PE ratio. They use stock price divided by earning. They get a P ratio. They use the P ratio multiply the earning to get the stock price. So when the company said that they expect to earn 7 to next year. I just give you 7.5%. And when investment bankers, they use a P ratio, they imply, even if they don't want to, that this company will have 7.5% growth forever. Because they use P ratio, right? They use price divided by earning and multiply by a number. This is why the stocks slumped after that. So as you can see, here I just replicate what investment banker will do. So I have 7 to 8%. I just give it 75%, and I gradual increase to 8 to 8%. This is just the average, and a gradual decrease to the 10 years government rate. So if this is really will happen to the Lululemon, the stock price can slump to $100 per share. But if you remember this chart, we have US industrial average 8.76%. We also have global 14%. So if you use 8% growth rate forever, you imply that from now on, Lululemon will become a mediocre company, no difference from other company at all. Is that possible? I agree that it's possible. It's always important to be less wrong rather than always right. So you should ask yourself, do you think it is more likely that the company have the 8% forever, or the company can have a little bit high growth? Do you think the company will be a mediocre company from now on forever, like the investment banker imply? Or do you think that this company still have some strengths that they can maintain for 2 or 3 years? This is the judgment you need to make by your own, and there's no absolute right or wrong because it's all personal opinion. That recall me about several recent hot stocks like Nvidia. When people buy Nvidia, they always say that the AI is a great future and this company can skyrocket. I agree that AI has a great future. I also agree have a high growth. But do you think that Nvidia can have about 70 to 80 revenue growth every year from now on? If you buy a company based on the assumption that it can have 80% revenue growth forever, the company can be still successful, but you can still lose money. When you buy stock based on the assumption that it can grow 80% forever, if the company grows, say, 50%, 30%, 20%, it is still a very successful company. But guess what? You are losing money because you are bet at too high. And in this case, I doubt that Lululemon can only have 8% revenue growth forever. I'll say it in another way. I believe that it is more likely for Lululemon to be a little bit better than the average than become a mediocre company. That's why I decided to still use this data set to see how much stock price per share the Lululemon will worth if they have different kinds of growth rate. However, when I check the data, I do find that I need to make some adjustment. If you check here, you can find that I have some very high 10-year revenue growth. It has over 1,000%. In statistics, this is called outlier. Outlier means that there will be a data that is much more different from every other data else in the data. And sometimes if you include outliers, it can distort the data. Just give you an example. Like say there's a group and you have 10 million people. Someone make $24,000 a year. Someone make $40,000 a year. Some people probably make a little bit like $1 million a year. If you have a data from these people and you run a distribution, you still can have a comparative representative data set. However, right now, say you have 1 million people, but you dropped Bill Gates, you dropped Warren Buffett, you drop their net income into this sample, the data can explode. If you use the distribution and you include every data, include those data, the data range fall into Warren Buffett or Bill Gates, of course you will saturate your data. If you invest in stock, there's a possibility that you can be Warren Buffett, but that possibility is very low. And if you plan your life based on the assumption that you will become a second Warren Buffett, and then your life will be much harder. So it is important to remove some outliers. I checked the data. These two data are from Under Armour. Under Armour, for some reason, used to have a extremely high revenue growth, but they have already fall to the earth. And if you check their stock price, you can really find that. So do some refinement. Right now, I only have around 100% to 500%. It's still very high, but I just want to improve that. And after that, this is the stock price I update. And as you can see, if the Lululemon right now, if it doesn't have any debt, the stock price will go to 259. If you consider all scenario, which means they take a lot of debt, they spend a lot of money on the marketing expenditure, the stock price can go as low as 200. And here is a distribution. The median is about 210. But this is a range. This can go as low as 90 and as high as 355. But in fact, the reason why you have 90 or 150 is because that company will have the double whammy. This data comes from those data that Lululemon have high debt, high marketing expenditure, but low revenue growth. It's possible, but the probability is low. But who knows? Maybe they try to get advice from JP Morgan and that will happen. Another thing interesting is about the traders pricing. Traders pricing, like I said in my last video, is how traders compare your company with other similar company. If averagely the apparel company have a P ratio stock price divided by earning 20 and your company have 15, they will tell you this company is cheap. But if the average is 20 and your company have 25, they will tell you the company is expensive. Here we have several data. I know you're probably not familiar, but I can explain. The first is the current PE. This is the PE ratio that Lululemon had last year when I valued the company. Other information are from New York University Business School. I can also include the data set in the description. The industrial trading PE ratio is for all the apparel company, how much the PE ratio is for the current year. And the aggregate market cap to net income is to add all the value for all apparel company and divided all income is about 20.93. Here we have all company and here we have only money making company. And this is what I do. So right now Lululemon at that moment have 23.20. I know this is a little bit different, but I keep updating. Sometimes I make some mistakes. Here we have 23.20. I gradually decreased to the aggregate data to 13.8. And this is all the price that I will get. And I also get the distribution. And as you can see that the average price that I think traders will set in the future is about 435, but it also can be 500, 800. Is that reliable? Let's take a look. Can you see here? It once reached to $400, and sometimes the stock up and down, and sometimes you will feel that the company doesn't have earnings, the company doesn't have anything happen. Why the stock goes up? The stock goes up to 400 during this place is because several investment banks they increase the price target. Some companies like JP Morgan they probably will raise the Lululemon price target from 350 to 400, and Citibank Bank maybe say we reach from 420 to 450. So whenever they reach the price target, in the short term, the price will decrease. But what is interesting that they will always do that afterwards. So I didn't hear any of them say the stock will worth 250 during this time. But after the company release the earnings, they start to adjust. After the company say they will earn 7 to 8% for current year, they start to say, we decrease the value from 350 to 300. We reduce the price target to 400 to 300. But for you, it is important for you to make prediction rather than be reactive to the market like those investment banks. And you can, I will show you other data. You will find another very interesting thing. Remember here that when I valued the company 1 year ago, the P ratio from, this P ratio at that moment is, I can only gather that from estimate. Yahoo Finance, Wall Street Journal, and those data are from analysts, from investment banks. At that moment, the P ratio they give you is 23.77. But after the Lululemon earning, they increased the P ratio from 23 to 15. You don't believe that? We can take a look. So if you see here, you can see that they already adjusted the P ratio to 16.21. But the one value that 1 year ago, when I checked the Nasdaq, this number is about 23. That's kind of correspond about my idea in my last video. It's really like people who are selling the diamond rings. Before they want to say that if you love her, you will spend 1,000 to buy the ring. If you love her, you spend 10,000 to buy the ring. Right now, they are saying if you love her, you need to use 1 year salary to buy a ring, and then they will say 2 years, 10 years, whatever. The problem with the using P ratio with the analysts is they claim that the stock price can be estimated with a sum rule. However, they keep changing the rule, as you can see. The reason I'm talking about this activity is not to criticizing or bitching about investment because I cannot care less about their activity. But to be successful in investment, you have to know about your about the competitors. You have to know other sellers and bettors in the market, so that you can maximize your capital gain. But at this moment, I estimate the value for Lululemon about 221 per share. So if they keep decreasing, I probably buy more. But right now, Lululemon is about 5% of my total stock portfolio. So if I buy more, I probably over concentrated. So I may sell a little bit when it goes high. And to decide when to sell, I plan to sell higher than 445. It's probably about $500. Some people will ask many times, you want to sell a stock. After you sell a stock, the stock goes even higher. You regret. But if you don't sell the stock will decrease, right? What you can do? Recall that when I buy the stock, I buy half of it. I buy quarter of it. And when you sell the stock, you also don't have to sell all of them. If it goes to about 400 to 500, I will sell half of my holding. If it goes to 800, I will sell another quarter, and it goes even higher, I will sell another quarter. And you probably ask, what if the stock keep decreasing? Well, if it's keep decreasing, it's keep decreasing. I always keep stock at 3 to 5% of my portfolio. Lululemon is a little bit over concentrated, but even I lose 50%, what a big deal. If I lose 50%, it's just 1 or 2%. If you put all your money in 5 stocks, each of them with 20%, and then if the stock have 50% decreased, and then you are doomed. Because right now you have 10% loss in your portfolio. You probably have all other stocks make money, but still end up losing money. So this is evaluation for Lululemon, and welcome to post your questions on the comment. Check out my website, my YouTube video, and even my Stripe. And thank you for listening.